If I could own only 5 individual stocks forever, these would be my choices. But before revealing the companies, we need to define what forever actually means. It does not mean buying a stock and refusing to analyze it ever again. It means choosing businesses with the durability, financial strength, and competitive advantages required to remain relevant for several decades. This is also a thought experiment, not a recommendation to build your entire financial future around only 5 companies. A 5-stock portfolio carries serious company-specific risk, even when every business appears exceptional. For this challenge, I want companies that operate different economic engines. I do not want 5 artificial intelligence stocks, 5 dividend stocks, or 5 companies whose success depends on the same market trend. Each company must have recurring demand, pricing power, a durable moat, financial resilience, and enough opportunities to reinvest capital. Management must also treat shareholder money carefully, and valuation still matters. A wonderful company purchased at an absurd price can generate disappointing returns. So these are not the 5 stocks I believe will rise the most next year. They are the 5 businesses I would feel most comfortable analyzing, owning, and monitoring through several economic cycles. To understand why these 5 survived, we first need to look at the 6 filters every company had to pass. The first filter is a durable competitive moat. A company must possess something that competitors cannot easily reproduce, such as network effects, switching costs, scale advantages, valuable infrastructure, or trusted brand. The second filter is pricing power. A business that can gradually raise prices without destroying customer demand has a better chance of protecting margins from inflation. The third filter is recurring demand. Customers should need the company's product or service repeatedly, not only during one temporary market cycle. The fourth filter is financial strength. A forever company must survive recessions, technological changes, regulatory pressure, and occasional management mistakes without placing the entire business at risk. The fifth filter is a long reinvestment runway. Strong companies generate cash, but exceptional companies can reinvest that cash into projects, acquisitions, innovation, or infrastructure that create additional value. The sixth filter is capital allocation. Management must decide intelligently between reinvestment, acquisitions, dividends, debt repayment, and share repurchases. Then comes the final gate, valuation. Business quality determines which companies deserve attention. The price paid influences the return the investor eventually receives. No company will score perfectly in every category, and every selection will carry meaningful risks. But the first company comes unusually close to combining recurring revenue, switching costs, cloud infrastructure, and an enormous reinvestment runway. That company is Microsoft. Microsoft is no longer simply the company behind Windows. It has become part of the operating infrastructure of modern business. Microsoft 365 supports communication, documents, spreadsheets, collaboration, and enterprise workflows. Azure provides cloud infrastructure and computing capacity. Dynamics supports business management. GitHub connects Microsoft to developers, while LinkedIn provides a professional network and valuable commercial data. In fiscal 2025, Microsoft generated approximately $281.7 billion in revenue and $128.5 billion in operating income. Microsoft Cloud revenue reached approximately $168.9 billion. The company's strength comes from how these products reinforce one another. An enterprise may use Windows, Microsoft 365, Teams, Azure, cybersecurity tools, GitHub, and artificial intelligence services within one connected ecosystem. Replacing one product can be inconvenient. Replacing the entire system can be expensive, risky, and disruptive. That creates substantial switching costs. Microsoft also benefits from recurring subscription revenue and enormous global distribution. Artificial intelligence expands the opportunity, but the investment thesis does not depend entirely on AI. Even without assuming that every Copilot product becomes a massive success, Microsoft already controls critical enterprise software and cloud infrastructure. That is why it earns the first position. But an outstanding business can still become a disappointing investment, and Microsoft's greatest risks are directly connected to the excitement currently supporting its valuation. Microsoft is spending enormous amounts of capital to expand data centers, computing capacity, and artificial intelligence infrastructure. That investment can create substantial future revenue. It can also become a problem if customer adoption and monetization develop more slowly than the spending. In fiscal 2025, Microsoft Cloud gross margin was approximately 69%, with infrastructure expansion placing pressure on margins. The company must convert higher capital spending into durable revenue and cash flow. Valuation is another major risk. When investors already expect excellent execution, even strong results may not be strong enough to support the stock price. Microsoft also faces aggressive competition in cloud computing, productivity software, cybersecurity, gaming, and artificial intelligence. Regulators may challenge acquisitions, platform behavior, bundling practices, or the company's influence over enterprise technology. Cybersecurity represents another critical risk. Large organizations trust Microsoft with essential systems and sensitive data. A major security failure could damage customer confidence and invite regulatory consequences. So, I would monitor Azure growth, AI revenue, capital intensity, cloud margins, customer retention, and cybersecurity performance. Microsoft remains an extraordinary business, but extraordinary business and attractive investment at any price are not the same statement. The second company reduces dependence on one technology platform by offering something very different: insurance float, operating businesses, public investments, and disciplined capital allocation. That company is Berkshire Hathaway. Berkshire Hathaway is difficult to place into one industry because it is not one operating business. It is a capital allocation system. Insurance subsidiaries collect premiums and generate float, money Berkshire can invest before future claims are paid. The company also owns major businesses in railroads, energy, manufacturing, services, and retail. Alongside those subsidiaries, Berkshire holds a large portfolio of public equities and an enormous reserve of cash and treasury bills. In the first quarter of 2026, Berkshire generated approximately $11.3 billion in operating earnings. Insurance float was approximately $176.9 billion, while cash and U.S. Treasury bills within the insurance and other operations were approximately $390.7 billion. That liquidity gives Berkshire unusual flexibility. During normal markets, the company can wait. During periods of financial stress, it can purchase assets, provide capital, or negotiate transactions from a position of strength. The decentralized structure is another advantage. Subsidiary managers operate their businesses with substantial independence, while capital can be redirected across the entire organization. Berkshire therefore provides exposure to several economic engines through one stock. It can function as a diversified corporation with permanent capital. But the company's size has become so enormous that finding opportunities capable of materially improving results becomes increasingly difficult, and that strength leads directly into Berkshire's most important risks. Berkshire's size provides stability, but it also limits future growth. A small acquisition that could transform another company may barely affect Berkshire's overall results. The organization now needs extremely large investments to move the financial needle. Leadership transition is another important risk. Berkshire's long-term success depends on preserving a culture of disciplined underwriting, decentralized management, patience, and rational capital allocation across future generations of leadership. Insurance can also produce volatile results. A year with major hurricanes, wildfires, or other catastrophes can create substantial underwriting losses. The company's large cash position creates both opportunity and drag. Cash allows Berkshire to survive crises and act when markets become irrational. But during long periods of rising asset prices, uninvested capital may earn less than operating businesses or equities. Railroads, utilities, and insurance operations also face meaningful regulation and large capital requirements. The conglomerate structure can make analysis more difficult because weakness in one subsidiary may be hidden by strength elsewhere. For Berkshire, I would monitor operating earnings, the cost and size of insurance float, subsidiary debt, capital deployment, and whether the culture of disciplined decision-making remains intact. Berkshire gives this five-stock portfolio financial strength, diversification, and capital allocation flexibility. The third company is much more focused. Instead of owning many businesses, it operates one of the world's most powerful transaction networks. That company is Visa. Visa is often described as a credit card company, but that description misses the most attractive part of the business. Visa primarily operates a global payment network. It connects consumers, merchants, banks, financial institutions, and governments. The company generally does not take the same consumer credit risk as a traditional bank issuing loans. Instead, Visa earns revenue when transactions move across its network. During fiscal 2025, Visa processed approximately $17 trillion in payments and cash volume and 329 billion transactions. The network supported nearly 5 billion payment credentials and more than 175 million merchant locations across over 200 countries and territories. That scale creates a powerful network effect. Consumers prefer payment methods accepted by many merchants. Merchants prefer networks used by many consumers. Banks want access to both groups. As the network expands, its value increases for every participant. Visa also benefits from the long-term movement from cash toward digital payments. E-commerce, contactless payments, mobile wallets, business payments, and cross-border travel can all increase transaction activity. The company does not need to predict which merchant wins or which consumer product becomes fashionable. It benefits when money moves through the network. But payment systems are changing quickly. Visa's future depends on remaining relevant even when the technology used to move money looks very different from a traditional card. Visa's network effects are powerful, but they are not permanent. Regulation is one of the most direct risks. Governments and courts may place limits on payment fees, network practices, merchant rules, or the relationships between card networks and financial institutions. Alternative payment methods may also bypass traditional card rails. Real-time bank payments can move money directly between accounts. Digital wallets may gain more control over the customer relationship. Stablecoins and tokenized deposits may create new settlement systems. These technologies could become competitors, or they could become new transaction flows that Visa helps process. That is why the important question is not whether cards remain physically visible. The question is whether Visa remains a valuable network when the form of money changes. Large financial institutions and merchants may also pressure pricing or negotiate larger incentives. Cybersecurity and operational reliability are critical. Visa's value depends on transactions moving quickly, accurately, and continuously. A serious network failure would damage trust across the ecosystem. I would monitor payment volume, cross-border activity, client incentives, regulation, new payment flows, and Visa's participation in stablecoin and account-to-account infrastructure. Visa brings network economics and global commerce to the portfolio. Before revealing the final two selections, this is the right point to support the channel's long-term business-first approach. If you prefer owning businesses instead of chasing ticker symbols, subscribe to Boring Money Wins. The goal of this channel is not to publish a new list of guaranteed winners every week. It is to understand how companies make money, why customers remain loyal, where competitive advantages come from, and what could permanently damage the investment thesis. If this analysis is helping you evaluate stocks beyond headlines and short-term price movements, click the like button. That helps YouTube recommend the video to more investors who want serious long-term analysis without unnecessary hype. So far, the portfolio includes Microsoft, Berkshire Hathaway, and Visa. Microsoft provides enterprise software and cloud infrastructure. Berkshire provides insurance, operating businesses, liquidity, and capital allocation. Visa provides a global payment network with powerful scale advantages. The final two companies add exposure to businesses that appear less exciting but benefit from recurring customer behavior and essential physical infrastructure.
The fourth company has created one of the most effective consumer membership models in the world. Its customers pay for the privilege of entering the store and then return in enormous numbers. That company is Costco.
Costco's competitive advantage is not simply selling large packages of products inside large warehouses. The real advantage is the membership flywheel. Customers pay an annual fee to shop at Costco. In return, they expect low prices, reliable quality, and a limited selection of products chosen carefully by the company. High customer traffic and enormous sales volume give Costco purchasing power. That purchasing power helps the company maintain attractive prices. Those prices strengthen member trust, which supports renewals and creates even more traffic. In the third quarter of fiscal 2026, Costco had approximately 82.9 million paid members and 148.5 million cardholders. The renewal rate was approximately 92.2% in the United States and Canada and 89.7% worldwide. Membership fee revenue increased approximately 11% during the quarter. The membership fees provide recurring, high-quality revenue. Meanwhile, the retail business operates with relatively thin margins, reinforcing the company's reputation for sharing scale benefits with customers rather than maximizing the price of every item. Costco also benefits from disciplined inventory management, limited product selection, private label products, and international expansion opportunities. The company earns trust first and monetizes that trust repeatedly. But investors understand the quality of this business. That creates a major risk. The stock can become priced for near-perfect execution. Costco may be one of the easiest businesses on this list to admire and one of the hardest stocks to value comfortably. The market often assigns a premium valuation to Costco because of its loyalty, growth, and consistency. When expectations become extremely high, even strong operating results can produce weak investment returns if valuation contracts. Costco's retail margins are also thin. Its gross margin was approximately 11.04% in the third quarter of fiscal year 2026. That means profitability depends on volume, efficiency, inventory control, and disciplined cost management. Small changes in labor, freight, merchandise costs, or operating expenses can matter. The company must also protect member trust. Membership fee increases can support revenue, but aggressive pricing decisions or weaker merchandise value could damage the relationship that makes the model successful. International growth creates opportunities, but new markets require suitable real estate, local purchasing knowledge, supply chain execution, and cultural adaptation. Costco cannot simply copy every warehouse into every country and expect identical economics. I would monitor membership growth, renewal rates, comparable sales, customer traffic, gross margins, and returns from new warehouses. Costco remains a remarkable business, but I would never confuse customer loyalty with immunity from valuation risk. The fifth and final stock is even less glamorous. Its products are not placed on a shelf, and customers rarely become excited about using the service. They simply need the service to work every week. That company is Waste Management. Waste management earns a place in this portfolio because trash does not disappear during a recession. Homes, businesses, hospitals, factories, and construction sites continue producing waste. That waste must be collected, transported, processed, recycled, or placed in a permitted landfill. Waste management operates an integrated physical network that includes collection routes, transfer stations, recycling facilities, landfills, renewable energy projects, and healthcare waste services. In 2025, the company generated approximately $25.2 billion in revenue, $6.04 billion in operating cash flow, and $2.94 billion in free cash flow. Approximately 71.7% of disposal costs were internalized within its own network. That internalization is important.
A company that collects waste and also controls transfer stations and landfills can retain more of the economics throughout the process. Route density provides another advantage. Adding more customers along an existing route can lower the average cost per stop. Landfills and permits are also difficult, expensive, and time-consuming to reproduce. Communities need waste infrastructure, but they rarely want new landfills built nearby. This creates significant barriers to entry. The company may not appear exciting, but essential demand, local scale, and physical infrastructure can create durable economics. However, a physical network this large requires continuous investment, and that makes capital intensity the first of several important risks.
Waste management's business is durable, but it is not effortless. The company must continuously spend money on trucks, landfills, recycling facilities, transfer stations, technology, and environmental systems. Capital expenditures were approximately $3.23 billion in 2025. Strong operating cash flow is therefore important because a large portion of the physical network must be maintained or replaced. Debt and acquisitions create additional risk. Large transactions can expand the company's capabilities, but they also require successful integration of customers, employees, routes, technology, and cost structures. Environmental liabilities can extend for decades. Landfills require ongoing monitoring, closure costs, regulatory compliance, and remediation planning. Labor, fuel, equipment, and insurance costs can also pressure margins. Waste volumes are not completely recession-proof. Residential collection may be stable, while industrial, commercial, and construction activity can weaken during an economic slowdown. Regulators may impose stricter environmental rules or restrict pricing and permitting. I would monitor free cash flow, debt, leverage, pricing relative to cost inflation, internalization, landfill capacity, and acquisition integration. Waste management is boring for a reason. The service is necessary, the infrastructure is difficult to replicate, and local route density can support attractive economics. But boring does not mean risk-free. Now that all 5 companies are visible, we can examine why they work together and the conditions that would make me reconsider owning any of them. The final portfolio contains Microsoft, Berkshire Hathaway, Visa, Costco, and Waste Management. Microsoft provides exposure to enterprise software, cloud computing, cybersecurity, developer tools, and artificial intelligence. Berkshire Hathaway provides insurance, operating businesses, liquidity, public investments, and flexible capital allocation. Visa provides a global transaction network that benefits as commerce becomes increasingly digital. Costco provides consumer loyalty, recurring membership revenue, scale, and defensive retail demand. Waste Management provides essential physical infrastructure, local route density, landfill ownership, and recurring service demand. These companies depend on different primary economic engines. That reduces but does not eliminate concentration risk. This is still only a 5-stock portfolio. It remains concentrated in large U.S. companies and lacks direct exposure to several industries, including healthcare and parts of the energy market. Company-specific mistakes could significantly affect the portfolio. Valuation also matters. I would reconsider any company if its competitive moat permanently weakened, its balance sheet became dangerous, management repeatedly destroyed capital, or the original business thesis stopped being true. A falling share price alone would not automatically break the thesis. Sometimes the market price falls while the business remains healthy. Other times, the stock price remains strong while the company quietly deteriorates. That is why forever is an ownership mindset, not permission to stop analyzing. Own durable businesses. Monitor the thesis. Never ignore the price. It may not be exciting, but that is how boring money wins.